Market structure is the most important concept. If you want to become a consistently profitable trader, and yet probably you will always find yourself on the wrong side of market. When you go long, price plummets your stop loss and go lower. And when you go short, price blast your stop loss and go higher. That is because you are missing a mechanical process to deciding what's your market structure every single time. And in this video, I am going to be share with you with my three mechanical rules that are the same every single time to help you never get caught on the wrong side of the market. Again and always have a clear bias for where price is heading to next. This video will be broken down into three main principles. The first principle is going to be understanding the difference between the breakup structure and the liquidation. Second principle is my box model, and this is going to be identify a proper high and a proper low every single time. And the third principle is my golden three pullbacks rule, which is something that completely transform my trading forever.
In front of me right now, we have two price diagrams. On the left hand side is a valid break of structure. On the right hand side is what I consider a liquidation. And the key difference, the key characteristical difference is the fact the diagram on the left breaks the old high with a very clear and obvious break and close above. You can see that this final candle breaks through this level and closes above the old high. If it breaks and closes above that high, that is confirmation that momentum is on the buyer's side. This confirms that price is going to go higher. But the diagram on the right hand side, when you see that price breaks the high, wicks above it, but then closes back inside of the range, back inside of this previous high, that is a liquidation. And what that simply means is that above this high, price was met with a lot of resistance from sellers. There was a large amount of supply that come back into the market, and this essentially tells us that price may not want to go higher from here. And there is a much higher likelihood that when you try to trade this, right, let's say for example you had an order block in here, right, or an area of interest in here, you wanted to trade this level. When price comes back, the higher likelihood is that price will trade through this level and continue trading lower because you didn't actually get a break of structure. Versus on this side, the break of structure has follow through, which means there is buyers on the other side of the market that are holding up price past that old high. So when you do see that pullback and you want to buy price in here, you'll have a much better chance of succeeding and making money. So the diagram on the left shows us what a true break of structure is, and a diagram on the right shows us what I consider a liquidation. And so many times I see traders get caught using the wick break as a break of structure, and then they get caught on the wrong side of the market and they end up thinking that price is going to go higher and price actually goes low. And these are things that I've consistently tested. This is not just made up, ideas and concepts. No, this has been thoroughly tested. So that is the break of structure versus liquidation. Now let's go into the box model and how we understand what is a high and what is a low valid. Now, essentially what we have here is a representation of price. You can see that price was bearish, right? We had a high, had a low, had a lower high, we had a lower low, then we had a higher high, right? A change of character. That is essentially when price shifts from bearish to bullish, first side. Then essentially we have this high and then this high gets broken. That is obviously a break of structure. And then price pulls back, puts in that break of structure. And now we essentially need to identify where is our current trading range. You always need to know what range are you trading inside of, because that's what's going to indicate where we're going to next. So it's obvious that we're bullish, great. So we have a directional bias, but we need to identify where should we be trading from. Now, the issue that I see a lot of times is so many traders think that this is the swing low in here. And what they do is they try to, let's say price continues, right? Let's say price continues up a little bit higher, great. And then what they want to do is they want to try to buy in this level. And so price comes back, and maybe you're guilty of this also, price comes back into this level, they get the little reaction, everything is great, and then price plummets through that level. And then what they think is, oh, okay, this was my low, I had a high, had a low, high, okay, so now we're bearish, now I should look at what? Selling. So then they try to sell from these levels, only to find that they get a little reaction and then price stops them out. And they're sat there and they're thinking to themselves, why on earth has price done that? We was bullish, I tried to long and we melted. We was bearish, I tried to sell and we flew up. And that's the problem. They don't have a rule in place, one that actually made logical sense. They just use any old high and any old low. So let me change that for you. What we do with the box model is we understand, right, that this was the low and this was the high. That was our current trading range. Our current trading range was high to low. And then when we break structure, we want to take a box. You can take the rectangle from the high of that trading range. And then essentially what you want to do is to the low of that trading range, from the low to the high of the trading range before price broke structure. Then when price breaks out of this box, that is your confirmation that the trend has continued. We have broken structure to the upside. Okay, awesome. So now we're bullish. Now we need to identify where is our low. What you want to do is you bring the box across, and now you need to identify the lowest point inside of that box, because that is the furthest that price pulled back before putting in a new higher high. Notice that this doesn't put in a high. We break and confirm the break on this candle. So we need to identify the lowest point that price pulled back, and the lowest point that price pulled back is here. So therefore that is our swing low. So we can map this out across here as our low. We can map this out right now as our high, and then we can actually use this as liquidity, because we know that so many traders are going to be using this level thinking that this is their swing low. So because of that, what that happens is lots of traders try to trade this level and lots of stop losses get put below this low. But because we know that and we have the box model, we understand that that's liquidity. So when price comes back in here, what we're waiting to do is buy from these levels in here in the discount from an order block, and then trade higher up here. And so whilst the other traders get caught on the wrong side of the market, they think price is going to buy from here, it doesn't, then they try to sell, and then it blasts through. Well, actually what happened was, this is the swing low, this is the swing high. All we're expecting is a higher low and a higher high. But only because we understood the box model was we able to identify that this is our swing low and not this. So be careful when you're marking out your highs and lows not to make this mistake. Make sure that you're following this box model. It will not let you down. So let's identify now a true pullback versus a fake pullback. And honestly, this is something that took me so long to figure out, and something that I really struggled with early on in my trading journey. So let me share it with you. I have a rule that I created that is a 3-candle pullback. It's essentially a mechanical, very precise, if this happens, then I do this. So you can see that price is bullish. We have a high, we have the low, we break structure, we have a high, and then price comes back in here. Now, if price continues higher, we automatically assume that this right here is our swing low, and then this is our swing high. Correct? Now, the rule is this only is valid because every break of structure needs a pullback, and then a continuation, and then a pullback, and then a continuation. Let me ask you, how many times have you seen price continue, have a little pullback, and then price continues, and then price does this? Again, very important, very similar to the last point. We have a break of structure, or you think it's a break of structure, then you have a bearish break of structure. So you try to buy in here when we break structure. When we pull back and continue higher, you try to buy from here, and then it breaks, and then what do you try to do? You try to sell from here, only to see what? Price goes up here. Why does that happen? That is because this was not a valid pullback. And with this rule, you would find that this is still the low to the high. And so actually everything played along perfectly. Very similar to the box model, but at the same time also very different. So if we look at this, what makes a valid pullback? If price trades higher now and we have a break of structure, what is it that makes this the low and not this the low? It's a pullback rule. What we need to see is that price gives us 3 bearish candles that close below each other consistently. So we have one bearish candle, and then we have the second bearish candle, and then we have the third bearish candle. We need to see at least 3 candles that come back, that pull back, and they have to break and close below each other for it to be considered a pullback. So then when price goes like this, now we can consider this is our low because it gives us the respected pullback. Here's an example of what isn't a pullback and what I see so many traders get mistaken with also. In this scenario, we have a high, we have a low, we have a higher high. Then what they're looking for is the pullback. And then let's say that price does this. Price trades higher. Now, the issue is that we only have 1 bearish candle, 2 bearish candles. The third bearish candle does not close below this previous low. For this to be a pullback for me, this third bearish candle has to close below this low. If it does not close below the low, it does not count. So then when you see 2 bearish candles that close below the low, the third one only wicks, and then we trade higher, this isn't the swing low. This also isn't the high. Then what happens is the trend continues. So let's say we break higher, our swing low is still down here, and then our swing high is still up here until what? Until we get this 3 bearish candle pattern formation. When we get this at the highs up in here, when we get that, now that's our pullback. Now that considers a pullback. So then when we break structure once again, right, we have push up, invalid pullback, push higher. This is still the high at this point. So it's from this low down here to this high up here. What happens to so many traders, if we remove this just for one moment, is they think that this is the low. And then what happens is price comes back down to here. They try to buy from here. They get stopped out. Then they think that price has shifted. And then they try to sell up here, not realizing that this is still the low and that price is still going to make higher highs because price is still bullish. This is something that I struggled with so many times. And the thing is, everybody tells us market structure is so important. Market structure is so important. But nobody tells us how we should identify market structure. Because if you don't have these rules in place and you try and go look at the markets and you try to use market structure, I can almost guarantee you will be wrong so many times. You just will. You'll be caught on the wrong side of the market. You'll think that price is going to trade higher. You'll draw a random low as your swing low, and then price will invalidate that low. And then you'll think it's bearish, and it's not bearish. This is arguably the most important shift in my trading. And it's something that has helped hundreds and hundreds of my students become so much better traders. Because every single day we can now show up and we know with 100% certainty whether our bias is bullish or bearish. And this alleviates so much of the guessing from trading. It makes trading mechanical. So that concludes